All right, so we know the Federal Reserve takes a certain amount of pride in the so-called wealth effect, even when it's kind of working against periodically those efforts to bring down the economy. Ironically, this time around, the rate hiking cycle did little to derail the wealth effect other than enriching the wealthier even more. I mean, they own most of the bonds, right? But Jay Powell is feeling really strong these days. He's feeling strong like bull. And, well, that's obviously rubbed off on the markets. Now, in fact, take a look at this. You've got two groups here. You've got the most shorted names, which have rocketed higher. And then on top of that, we've got this is what's most incredible, unprofitable tech names. These companies make no money, no money. These stocks have erupted higher. This is a mind-boggling move. So it's because of this magic trick. I want to give him a new moniker. I think the sorcerer might be a good one for him. Joining me now to discuss, Northman Trader co-founder Sven Henrich. Sven, so far, I mean, listen, maybe it's too early, but I think when it's all said and done, if Powell has hit the mark and pulled this off, the sorcerer might be a good nickname for him.
Hi, Charles. Yeah, a miracle on Wall Street. Again, a dovish Fed just before Christmas. Imagine that. Now, look, the rally in 2023, and I need to be absolutely clear about this. There's been this tightening myth all year with the Fed raising rates and QT still running through the system. But I think what a lot of people miss is all the liquidity backstops that kept being placed underneath the market with bank reserves. Peak tightening was basically in October of 2022. Bank reserves got cranked up in March during the banking crisis. The BTFP funding program got thrown into the mix. All these things have grown ever precipitously higher this year. In fact, bank reserves have increased $400 billion since October as yields then also reversed. And so the cumulative effect is a massive easing of financial conditions. So in this context, it was actually kind of baffling to see Jay Powell basically light the whole place on fire, further easing financial conditions. And that's what we're seeing with equities. Yeah. And equities are, in this sense, being totally rational in this regard.
But speaking of irrational, though, the messaging, right? Because all of a sudden, start Monday, all these other Fed officials are coming out. You had a great tweet. I love your tweets. So this is one sort of echoing what the Fed is saying. We may do 3 rate cuts. Nothing discussed about rate cuts. The market's presuming too many rate cuts. We may do more than 3 rate cuts. We're confused by the market's reaction. Why are markets ignoring us? So the Fed knows, right, how the market's going to react. I mean, Jay Powell had to know that the market was going to erupt off of that press conference.
Yeah, absolutely baffling, because, especially in context then some Fed speakers coming out expressing surprise how the market reacts. Have they not been paying attention the last 15 years? I mean, the Fed has been conditioning the markets for the easy money train, and that's exactly what's happening now. So if they did not want further easing in financial conditions, then what in the world were they thinking putting this out there? And the risk, frankly, is, with the wealth effect, markets going back up to new all-time highs, that with core inflation, may I remind everyone, is, while having greatly improved, is still at 4%, very high above the Fed's ultimate target. And the risk is, if you're now going back into, everything melting back up, that inflation may come back. Now, Janet Yellen may certainly need lower rates to keep funding that enormous fiscal deficit, by the way, which has also been a liquidity backstop here in 2023. And so she needs lower rates. But if you're risking with all this easing of financial conditions, which are now as loose as they were before the Fed even started raising rates, then you're running the risk that comes back, and instead of cuddling up with Paul Volcker, Jay Powell runs the risk of skinny dipping with Arthur Burns.
Right. And that's the irony, because they made it clear, even in a well of the Senate, Jay Powell made it clear he wanted to be Paul Volcker and not Arthur Burns. So let's talk about this market, because I know you've been bullish, but we've seen some parabolic moves. Now, I just put the equal weight up here just for, just to underscore the kind of move that we're seeing. I mean, this is straight up. That's the definition of parabolic. We're at a key resistance point where we're at an high. We can see relative strength at 79. Are we overbought near term? And if so, do you remain bullish and just ride a few bumps along for here?
Yeah, I mean, we've been aggressively bullish, been pointing that out, especially in context of a historic market runway, which is when the Fed pauses or ends its rate hike cycle. That's typically bullish. When yields make their peak in a particular cycle, that is always bullish. And you end up seeing markets making new all-time highs before any potential recession. However, this move again, just absolutely parabolic as you just pointed out. And we're seeing some signal charts flaring up warning signs. I'm not saying a top is being in the making, but this is the kind of readings where you ultimately end up with a sizable correction. And frankly, 2023 is a presidential pre-election year. And what we're seeing here is similar to what we saw in 2003, 8 weeks straight up. And that can continue maybe into year-end, early 2024. But these presidential election years also have their own seasonality, and that tends to be quite a bit shaky in Q1 and Q2, and setting up for corrective moves. But these end up being ultimately bought. I would also just add to this that we have tax loss selling or tax considerations because people want to hang on to their tech gains in particular before the new tax year takes an effect. So we may see some selling on the heels of that in early part of the year.
All right, so stay the course, but buckle up. Sven, thank you so much. It's been too long. Talk to you again real soon.
You bet. Thanks, Charles. Merry Christmas.
You too. Merry Christmas.